I'm Max Feitz, local Keller Williams agent in southeastern Wisconsin, and we are doing a video podcast here with the one, the great Aaron from A Plus Mortgages, and we also have Dr. Alicia Ann Hallenrand. Now that title is not important at all for this video, but I think this video is going to be really helpful for everyone who's starting out looking for their mortgage, and I think the best case scenario is to just have that conversation with you and talk about what that process is. Basically, from the moment they come to me or they come to you and they're like, hey, I'm thinking about buying a house and I just don't know where to start. That's where I think this conversation is going to be really helpful to everyone who's going to be able to see this. So one thing is I would love for you to just kind of introduce yourself, a little bit about yourself and your background and how you got into the mortgage business.
Sure. So again, I'm Aaron with A Plus Mortgage, and I actually got into the business 18 years ago, right out of college. And for those who don't remember 2008 and what took place at that time, it was a very, very different industry back then with very different regulation. With that, there were some crazy things going on in the marketplace with this where loans were getting approved that really shouldn't have. Appraisals were getting done with different things going on under the table. And quite honestly, within about a year, even though business was going really well, I left the business. Due to not really being able to sleep at night with some of the things going on.
I get that. I do.
With that said, I got back into the business over the last couple of years after also being in the business in a roundabout way for the last decade with 16 real estate properties, rental properties that we have. So I was always running the numbers with that.
Yeah.
Kind of being that guy in the analytics sense for my friends to find out, should I get this new mortgage? Should I get refinanced? And it was just something that I never thought about getting back into at that time. And then it organically happened over the last couple of years, and it's been really great.
Honestly, that's a really big factor because when I'm helping people who are thinking about rentals, we are constantly, like the very first barometer, besides taxes, is where are we with the rates?
Yep.
Where are we with mortgage rates? Because that could kill your ROI. Like not only like your rent per door or whatever, but if you got into a point where you needed to refinance later or how that affects you, that's immediately in our formula of what are we even looking at. So like duplexes in the market, they struggle to have a very productive ROI, mostly because of their competition. And we are seeing just a slight rise in mortgage rates, nothing crazy. Like when I look back 2 years ago, 3 years ago, and people start, they have the clickbait and they're like, oh, mortgage rates are on the rise. What are we going to do about this? To me, it's comical because I just go, oh, what did we do in 2019? What did we do in 2018? We're still at very reasonable rates. And Absolutely. I think that's one of the things that may scare people when they first come out in their first home buying or home shopping. And it doesn't even become really a part of the conversation because the very first thing we talk about is, let's talk about if you're ready, and let's talk about if you're absolutely ready with your numbers. Like, do you have money in the bank in your savings? Is this a good time for you to move? So one of the biggest things in the world is like, are you going to be there more than 6 months, 10 months, 12 months? I'd like, to help them plan and budget according to their goals.
Absolutely.
So one of the things that I just wanted to kind of have a conversation with you about is when they first come and they have that conversation with you, how does that normally go? So I just, I call you based on an awesome referral from me. And you pick up that phone. How does that conversation normally go? What is that discovery process like?
Well, you already touched on the first step. First and foremost, we want to identify what are your goals.
Yeah.
Overall. And, on the high end, on the stretch goal, if you found out something that literally checked all of the boxes, what's the high end goal if you're willing to stretch that a little bit? What's the low end goal? Why? Now, some people maybe don't, there's not that deep of a why, but we want to understand so we can be working for you.
Yeah.
Now, as things change in the marketplace, because sometimes it might be 2 or 3 months or longer than date of pre-approval to when they're finally getting the accepted offer. So along the way, we want to understand those wants, those needs, those must-haves, those goals, so we can be a true partner to both you as the agent, you as the client through the process and make sure we're working for you. And then from there, there's really, for a pre-approval aspect, there's really 3 main things, 3 main buckets, I'll call them, that we would look at for the pre-approval. Now, number 1 would be obviously the application where we're looking over credit. There's also income. So whether you're a business owner, it'd be tax returns or pay stubs if you're not a business owner, along with W-2s. And then, so along with the application, along with income, then there's the down payment verification. So your assets, basically, whether it's investment statements, bank statements, things that we want to verify to make sure. Now from there, based on those goals, somebody might say, we want to put 20% down for reasons X, Y, or Z, which we'll get into, I'm sure, in this conversation.
Yeah, that's going to be a part of it.
Others might say, I'm a first-time home buyer. I want to put down as little as possible so I can save some money, have some in the bank for when the water heater might go out, or the just in case, and they want to be prepared. We have options for both. But again, now that we understand those goals, we can work with them on that and make sure that we're providing the right options. Absolutely.
I mean, we utilize all that parameter. So what they have for a down payment, what they can afford after they're in the home. Yes. That's a real conversation that I think most people don't have. Is we absolutely, when we team up and we help people, we absolutely make sure that when they move into the house, they're not cash poor. They can't even afford to put a fold-up picnic table in there. That's not the goal, obviously. Now, granted, we're just subject to what they want and what their goals are. And if they want to stretch as high as they want to because they're taking advantage of mortgage rates or whatever, we're subject to helping them as they see fit. But I do value the point that you mostly are an educator. Absolutely. So whenever I'm talking to you or helping guide a client through you, we're talking about, yes, down payment. So one of the things that I think would be pertinent is a lot of people don't really know what determines their ability to purchase as far as their top rate. So are there minimum credit scores that if they're below that, it's kind of do you guys just have to plan and wait a little bit longer before we can make an appropriate loan package that would actually help you in the home? Sure. Or are there down payment what's a minimum credit score, lowest down payment that you guys could actually formulate a loan package for?
Absolutely. Let's talk about both those separately here.
Okay.
So on the credit score side, the standard is 640. It doesn't mean it can't get done lower than that, but it typically means it's going to have to go through full manual underwriting. It's not going to get approval through automatic underwriting. It still has to go through a portion of manual underwriting regardless. But with that, there's a reason typically why the credit is at that point. And we don't frown upon it by any means, but we don't want to lead somebody on only to then find out at the final hour, oh, just kidding, this won't happen. We believe in transparency, honesty, all of that on the front end. So a quick story on that would be, this past October, we had a client of all places actually from the opposite side of the state in Eau Claire that was referred to us. And she had a 625 credit score. And we were the fourth loan officer that she had gotten to. Two of the previous ones said, yep, not a problem. We'll get you this. She got the accepted offer, and then everything fell apart, and she was devastated.
Oh, that's a terrible time to have the deal fall apart.
So instead of repeating that, which we wouldn't do anyway, we did prep her. There's going to be some steps needed. I'm not going to give you the pre-approval right now. We very quickly found two things. Number one, an old judgment that was actually paid in full, but it wasn't filed with the courts as satisfied. Quick, easy step, quick education, walk her through it. Yeah. 2 days later, it's now shown as satisfied on circuit courts, CCAP. And number two, our system is synced up with something called Credit Expert. It gives a probability score and rating. So in this case, it said plus 30 points, 92% probability. What happened was just two of the credit cards that she already had just needed to be paid down about $300 or $400 each. She had money set aside. She could quickly do that. We filed a rapid rescore and update with the bureaus, and which cost about $50 per bureau to do. We do it on our dime. And just 2 short weeks later, she's now up to a 655. No more judgment. Credit's up there. She's approved. She's now in our home.
So what's the difference between the manual and the automatic?
Underwriting.
Yes, thank you.
Automatic underwriting, when it's being filed through, if we get an approved eligible as a loan officer, we know as long as the application was done accurately and the information that was provided and input is verified and accurate, we're getting an approval on this loan. There might be some steps or some hurdles to jump over versus on the manual side, we're not getting that. So now we're really guessing more or less, where this is something where with us, and when I say us, A Plus Mortgage, we're actually a mortgage banker that acts like a mortgage broker. We'll talk about that in a little bit here as well.
Very interested in that. Yeah.
But with that, we're local. Our CEO, our underwriter, our processing department are all right here in the greater Milwaukee area. I talk to our CEO weekly. I talk to our team leader almost daily. I talk to our processing department daily. I talk to our underwriter at least once or twice a week through email or over the phone. So in that case, rather than submitting it, I'm probably going to have, I'm going to be making a call to her and saying, can you take a look at this file with me? This is where we're at. And she's going to say, well, there's something that put it there, but we're going to take a look. Even though what I did with this other client that I mentioned from October, even though I knew we could get the credit score up, and we did, even though I knew we could file, correct the judgment, and we did, I still had her take a look with me to make sure we were ahead of the curve on it.
Okay.
But after those two things were corrected, we did get the approved eligible. With the automatic underwriting, it still had to go through her as an underwriter. Without that, though, it's all just going into the underwriting department. So there's a much higher risk considered in that loan.
Okay.
And it's got to be done a lot more diligently to find out, okay, what's going on here.
Okay.
More or less is what it comes down to.
Okay.
So on like the point of underwriting, there's two different when I'm on the listing side, a pre-qualification letter versus a pre-approval letter are wildly different things. Wildly. And a lot of people I don't think understand that. I have to have very informative conversations with people, both when I'm listing a home or buying a home, depending on the situation, is if you bring, and I'm not going to name the name of the companies or whatever, but if you go online and after 30 seconds and almost no information that you've provided them, including like your W-2s, your tax returns, any of the actual in-depth material, and you come back with a letter saying that you were pre-qualified or whatever, does your company do that? I mean, does A Plus Mortgages even provide the pre-qualification letter? Because I know as a practice, because it's one of the best ways to get our offer, a winning offer, because our agents are educated.
Absolutely.
And this market dictates that you can't bring a pre-qualification letter to the table, especially with somebody who's well known to not be able to close, versus like the big thing you mentioned that really resonates with me is local. I don't think a lot of people realize that sometimes when you apply to a company and you put all your information, they send it to basically a room full of underwriters who do this for like thousands of applications, and it's not diligent. It's kind of off the cuff. I mean, can you speak to the difference of like a pre-qualification versus the pre-approval letter?
Absolutely. Let's talk about exactly that. Let's talk about the local aspect, and then I still need to circle back around it and talk about the down payment differences. With that, as far as the pre-qualification, it's really, you mentioned 30 seconds or a minute online. I call it clickbait.
Okay.
You're really clicking on a link online more times than not. You're submitting the information, and none of it is verified. And from there, like maybe you actually don't have the funds available, but you put it on there anyway, and you're going to get it as a gift. Some old roommates owe you some money. Well, guess what? That's not going to be sourced properly.
Yeah.
A roommate is not considered a proper approved gifter, and now suddenly you're going to run into an issue.
The gift. What is a gift?
If let's say you don't have the money that you need
for like a down payment,
for a down payment or something of that nature, and you're going to get a gift. It's not uncommon from maybe parents or a different relative.
Yeah, that makes sense.
Or a fiance, but it's got to be somebody that is approved, not. So those are things that need to be verified.
I'm sure there's a reason for that. You just can't have a sketchy amount of money enter your bank account, and then you're like, I got it. We're good. Don't worry about it.
Correct.
Here's a picture of a pile of cash. Will that be good enough for pre-approval?
So we had somebody think they were pre-approved recently that was then referred to us. They were actually through a credit union. I won't mention the name. And it was actually a pre-qualification letter. They got there. They wanted to write the offer. The agent fortunately actually knew more than who they were actually talking to at this credit union, and talked about minimum down payments, which we still need to touch on here. Yeah. And she said, I don't have that money. And she said, I know somebody else that can do it for 3% down and even gift you the closing cost. But even then, it was for the place they were looking at, I don't have that money. And ultimately, we work creatively. We have her fully pre-approved right now. Pre-approval, those 3 buckets I spoke about of the application with the proper information in there, and then the verification of the down payment funds, the assets, and the income are all actually verified. With that, we want to make sure that when you walk out with that pre-approval, it's like gold, and that's the reputation A+ as a company and as a team have really cemented ourselves in this community with. Of if they say if you're getting a pre-approval from them, you're in great hands.
Yeah, that is, you have built up that beautiful reputation. It's honest to God one of the reasons that I decided to work with the team. I mean, even the Schnabel team, and especially with you, is I have the gold standard. I know that if something gets kicked back in an offer, it's not because we weren't pre-approved. It's because of it not enough money overall or whatever. But it has nothing to do with that letter.
Absolutely.
That letter is just a gold standard in our community. And it's recognizable. So the other thing that getting into the business, I think a lot of people don't realize is that when you're submitting offers, the title matters. The top of that page, who gave you the pre-approval, matters a lot. Because when it comes to deals falling apart, and especially if we remember who they got it from, that's a sour taste in everyone's mouth. The unfortunate buyer who had the deal fall apart, the seller who was expecting to move on to their next home,
Absolutely.
Both agents who thought it was going to come together, along with, family members volunteering to help them move. It affects a lot of people. So I'm really excited when I work with, you and I get to put it on the letterhead. I know that's never going to be an issue. So, sorry, to circle back also to down payments.
So down payments, first off, there's many different loan programs. Anything from obviously conventional loans, and that can stretch a couple different ways. We'll talk about that. To jumbo loans. Jumbo loans would be any mortgage that is above $647,200.
Very specific amount.
Very specific. I tell people just remember $650,000, and then we'll talk about the couple of grand from there. But then there's FHA loans that allow you to come with as little as 3.5% down. There's VA loans where if you're a veteran and have the certificate of eligibility and are qualified in that program, where you can come with as little as 0% down. There's also USDA loans that we do that are 0% down if you meet the income limits and it's in a rural area. That would fall in line with the USDA map. But I do want to touch a little more on conventional loans here. Conventional loans, as you know, but those that might be listening may not be as aware, are the most attractive loans when it comes to, if you're the listing agent or other listing agents out there, they know there's going to be less contingencies with the appraisal or inspection process. So usually they like to see conventional. And most conventional loans are going to start at 5%. However, if you're a first-time home buyer, there's a couple different programs from Home Possible to Home One to a third one as well that's on the Fannie Mae side. And they allow you with as if you qualify for them to come with as little as 3% down.
Yeah, I remember that. We've had a couple clients that came in around 3.
Absolutely.
They were 3.
So it's working creatively where a lot of times I'll talk to clients saying, "Oh no, I don't qualify for that." We look and realize it's a husband and wife or a somebody and their fiance on the loan, but they are approved with just one of their incomes. Well, now putting just one of them on, suddenly they'll get approved for it. We'll educate them on this. They can still both be on the deed and the title. So
in a marriage, can only one person be on the loan?
If they choose to.
If they choose, and that could possibly help. Okay.
We have that exact scenario going on with a couple clients right now. What that allowed is we went from 5%, which if we're talking a $300,000 loan, that's $15,000, down to 3%. Now it's $9,000. That's $6,000 now left over that they would love to keep in their pocket.
Yeah.
Additionally, the Home Possible loan now typically is a little bit more competitive rates, even though you're putting a little less money down. And it also has a little bit more competitive PMI. So what PMI is mortgage insurance. It's something...
Why is there a big, when you talk to a little bit of the older generations, there's this big stigma behind PMI, getting rid of PMI.
Gotta put 20% down.
Gotta put 20%, like the Dave Ramsey, 20% down or don't shop for a house. But when you like run the numbers, that just financially, it would take the average person forever to get into their first home. Or it just doesn't make sense to dump that much into equity with the rates being as low as they are, with PMI being very minimal. And then if you include inflation into this equation in any way, shape, or form, it actually makes sense to put less money down on in the initial down payment. Depending on the scenario, obviously.
Depending on the scenario and their goals, but
Yeah.
you're onto something. Using that same number I used of 300,000, 20%, we're talking $60,000.
It's an incredible amount of money.
Versus the Home Possible, you're talking 3% while keeping it conventional. That's a very, very broad range.
Yeah.
With that, for every $1,000 difference on average, I tell clients, if they're thinking, okay, if we wanted to do more, or if we're talking about it, if we're going up in price and exceeding, what is this going to do as a difference? Typically, every $1,000 is about $5 difference on average, depending on the exact rate.
No, that makes sense.
And scenario, could be a little more or
You're
less.
saying like 325 to 326, it's like a $5 difference per month.
Correct.
Okay, yeah.
So if you are putting an extra $50,000 down, yes, it's reducing your payment by, call it an average of $250, not nothing.
Yeah.
But you're giving $5,000 on the front end. Even with rates, as you alluded to earlier, being still historically low, most people are going to say, well, what if I took that 50 grand and invested into real estate and made 10, 15, or 20% on that? I'm doing a lot more with that money versus putting it all in. Or obviously the stock market, despite all challenges we've gone through as a country the last few years, has still gone up.
Yeah, when you're looking at the trend, when you back out and don't look at it day to day or month to month, there's still a linear regression line that's upwards.
Absolutely. Now that $250 does not include the PMI. However, we ran the numbers with somebody that was going to do 20%, chose instead to do 8%. Don't ask me why, it's just the number, the amount that they wanted to go with. The PMI in that scenario was $30 a month more.
What's PMI?
It's mortgage insurance that is required if you're not putting 20% down, which is what I think Max was talking about, why a lot of people think, oh, I need to put 20% down. It's true. If you have 20% down, you don't have the PMI. But we can run those scenarios once we understand, everybody's goals, present them with both options, and then crunch the numbers together based on your goals and identify, does it make sense or not?
So what is the PMI? I mean, I know it's required if you're not putting the 20% down, but what do you benefit from having it? Like, I guess, what does it actually do?
More or less, the benefit is that you're getting the loan. It's protecting basically the mortgage company. It's not actually paid to the mortgage company. It's paid to a third party, PMI company, but it's to protect the mortgage company, like mortgage insurance, in case you would default on the loan.
Okay.
There's an added layer of protection. And typically, if you're going to have 20% down, you now already have a good chunk of equity built into the loan and into the home, where then it's not required.
So is that like a monthly payment that the home buyer would?
Yep.
Okay.
So it'd all be built on to the loan.
Oh, okay.
In terms of you'll have your mortgage, so your principal and interest, your PMI, if you have it. If you have 20%, then that's not there. Your taxes and your insurance.
Gotcha.
If you have 20% down, you can choose, I want to do the taxes and insurance separately. Most people like to do it together. So when that comes at the end of the year, it's just paid for. You're not scrambling.
Sure.
If you had the what if just happened over the last couple of months, you're not scrambling for funds. You're taken care of, and you're not scrambling right after the holidays to go pay your taxes either. So.
Okay.
And it does, because there's your side of the PMI and then there's ours. So like the example I'm bringing up is when we go in competitive offer situations and they're thinking about 20% down to avoid the PMI, it's always just enlightening to be like, let's have Aaron run the numbers on what it would be if you had lesser down payment so we could bridge the appraisal gap. Now that's an entirely different topic, but it allows us to be crazy more competitive when we go to the actual offer table and we're able to be like, hey, if the loan doesn't come back with this, which the appraisal doesn't come back with the value of the home,
Yep.
we can bridge the gap. The way that we can play with the numbers is the fantastic part is a lot of people have that stigma. They're afraid of having PMI in their mortgage because they don't understand like the actual payment per month. Now, I think a lot of people, when they think about it, they're thinking like grandioso numbers. And a lot of times when I come back, it's the numbers makes a $27 to like $45 difference in their monthly payment. But the whole thing is wrapped in we win the house. And why that's so important is right now when we have competition of anywhere from like, even if it's 3 other buyers, but in like New Berlin, Tosa, we're experiencing 15 to 30 offers.
Absolutely.
Having that competitive advantage is such an important part of when we go to write offers, and having the flexibility to even put 20% down versus PMI. The PMI is just, it rapidly becomes like a secondary conversation when you actually have numbers applied to like
Absolutely.
what that value is. And that you won't have it forever unless you're in an FHA loan or something of that nature. But the conventional, you can refinance once you get to that point if everything's considered.
So does your PMI monthly payment change depending on like how much you put down or how much the loan is for?
It can. If you're putting 5% down versus 10% versus 18%, the more you put down, it typically is going to be a little bit less because you are putting more equity, putting more money down to build immediately more equity, more loan to value, as we call it in our world, into the home.
And then when you're sitting there trying to figure out how much to put down when you're getting ready to buy a house, how do you decide how much to put down? Is it like, even if you have enough for a 20% down payment, how do you then decide like, well, maybe we only want to do 15 or 10?
Those are things, again, going back to the goals that we talked about earlier. It really is situational. A quick story on that one would be a client I'm working with right now that when we first spoke, they said, our current rent is $1,000. It's going up to $1,300, $300 jump in rent overnight. Oh my gosh.
Yeah.
Which is why they started looking.
Sure.
And they said, we don't want to go more than that.
Okay.
They were approved they fell into that home possible category where I said I can approve you together, or we can look at one of you if you want to keep the down payment lower and do home possible and save money. So we knew we had both options. We had them pre-approved both ways. From there, I told them, you're actually pre-approved where your monthly payment could go all the way up to about $2,000. They did not want to go. They don't want to be house poor, as Max spoke about earlier, and this is all about the goals. Mm-hmm. However, that prompted us to go in the conversation of what if. What if at $1,300 a month, what you're finding checks some of the boxes? And they said, yeah, that's fine. It's going to be a starter home, and in 3 or 4 years, we're going to sell it and move. Mm-hmm. I said, okay, what if you walk into something that you absolutely love, and it's going to be above? What's the highest you're willing to go? Not that I wanted to push them there, but I wanted them to be prepared ahead of time, along with their agent, where that's having the right team together. And suddenly they said, well, $1,600 to $1,700, but we're not going to go there. Mm-hmm. Lo and behold, they added a couple properties in, and they said, well, this is not a home that we want to move from 3 or 4 years from now. This is a home we would want to keep staying probably for the rest of our lives, and we're willing to now jump to that $1,600 to $1,700 a month because it checks all of those boxes. Suddenly now we're going the route of, okay, let's go that home possible. Now let's put less down so you can jump to that and still have the down payment funds and some money left over to furnish it and feel like you've got a little emergency fund there as well. So again, it really, they might have, somebody else might have had a lot more sitting there saying, I don't care about any of that. I just want to put 20% down. Great. We're not going to try to talk you out of it, but it all comes back to that initial conversation. And obviously plans and goals may change, and that's great. But that's why we want to know that from the first start of the conversation.
Okay.
Yes, talking with people about their goals, like initially, is vital because of conversations like that. So I've had a lot of first-time home buyers, and when we go out, they have this idea of what they want based on their rentals or their parents' home that they grew up in. Well, when we start seeing what's on the market and what the inventory looks like and the price point they initially started, we unfortunately, from time to time, see a home that's mildly above, like their original budget plan, what they wanted and what they thought they could get for their money. And then when we have a little bit of exposure to the market and what the market offers, their goals change, which is totally acceptable. I completely understand. I can't even decide on like a car, my next car. So I don't understand how people are able to make a solid decision before they see what's available. And I really sympathize with that because it changes how we structure their loans sometimes. So when we're going, just like his example, when we're going shopping and we find something that's not a first-time home for them, it's going to be, where his home office is, where the kids are going to grow up. They found the perfect soccer program in this school district, and Absolutely. They were going to grow to that eventually, and found out that they could make that jump first, like without the growth period and without making them house poor. It restructures how we have to handle that on the loan side. And that's, honest to God, the flexibility.
So you can do that mid-shopping process. Be like, this is what we originally thought as our down payment and our interest rate, and then now our goals changed. Can we get a new pre-approval letter?
Yes,
midway
absolutely.
Through? Okay.
And on that point, I know we talked earlier about local. Some people will say, well, my bank is local. It's right down the road. To a couple things on that, to Max's point from earlier. Yes, physically, they're right down the road, and there's some wonderful people working there. I don't dispute that, and I won't name any specific names. But with that, to what Max said earlier, a lot of times their underwriting, their processing, it's not done in-house there. It's done somewhere out of state, which is important for what we talked about earlier when we do need to pick up the phone and or physically drive there and work through a unique scenario.
In my area, when my loan officer is slow to respond, slow to
that's
change
what I was
the
gonna
deal,
say. Bankers
it
always.
kills us.
Bankers always where I was going to
It
go with
kills
that.
deals. I hate to say it this way, it kills dreams. Like when they figured out, oh my God, this is the home that I need, and we need to restructure something to make it work, but it's been on the market 4 hours, and guess what? In this market, we have another 6 before they accept an offer, and I can't get a lender on the phone, or he has to get 3 people's approval before we do anything. It kills dreams because
That's exactly it.
I can't get and all of our hands are tied just because we don't have the flexibility. And that's actually one of the questions I wanted to ask you is, what is the difference with going with a company like A Plus Mortgage versus going to Wells Fargo, Landmark Credit Union, BankFi, all these different major national banks who have it seems like they should have the capability of doing things at a grander scale and making more programs available. How is it A Plus Mortgage still beats them every single time across the board?
So with that, a couple different things with it. First off, with the bankers hours is where I was going to go with that. In terms of, it's wonderful. Bankers hours has been the joke our entire lifetimes.
I mean, they're in a bad reputation.
But with that, we did a pre-approval where I have my phone synced up, where if I need to make a modification to your point, and I have notes and a file in my email for each and every client, it's 8 o'clock last Friday night. I'm out to dinner with my nephew and his wife.
You get a call from this guy?
And we need this pre-approval updated.
Yeah.
I'm pulling it up right there, and we're getting it, and we're calling back and saying, has anything changed? On a Saturday morning, we're going to get a call at 9 o'clock saying they need to get pre-approved. They didn't think it was important, but now they found a place and offers are due by 10 or 11 this morning. We're scrambling, but suddenly it's 9, real story, 9 o'clock. By 9:55, the pre-approval letter's in their hand, and by 10:15, they've got the accepted offer.
Nice.
Not in every case goes like that, but we've had a couple.
Okay.
So those are a couple things that way. Really, when you're going through one specific location, you're typically getting their one rate, their one offer. You're at their speed of processing, how they partner with appraisers, how their closing department might operate, where we sometimes hear, they couldn't close within 35 or 40 days. Then there's mortgage brokers who are going to shop several different options for you and be an intermediary between you, the client, and whatever option fits your goals and or rates the best. Then there's mortgage bankers, which is what A Plus Mortgage is, where, like a mortgage broker, we're shopping all of these different options. The difference is A Plus mortgage banker is actually funding the loan, closing on it with their own funds. It's in their actual name, and then it's moving on to the servicing company after the fact. Why that's really important, it allows that flexibility to suddenly we need to push up closing. Well, if I'm an intermediary going directly to this company over here, well, they don't have the flexibility to do that closing. They don't have the flexibility of their closing department to change things on a dime like that. They don't have the flexibility to close, and we had one in 18 days this year. Alex, our CEO, is probably like, don't advertise that.
Oh my gosh.
But we've done it. We picked up other offers where it fell apart 3 days to closing, and the seller was going to walk away from them. We looked, saying there's no reason this fell apart, and we push it through where 20 days later we're closing, and that quick timeline allowed the buyer to still stay in the deal, which is, now it's affecting people's lives, their dreams, in addition to the sellers, for that matter, as Max talked about earlier. So there's many different things. There's many wonderful companies out there. I don't like to bash any particular name because there is a lot of great companies, but those are a couple of the really specific things that A Plus Mortgage is truly amazing on, and why I chose to join them, being very selective when I re-entered this business.
Yeah, and honestly, on my half, it's made a world of difference, because I can't tell you how often we are making deals happen past 5 p.m. So most people, a lot of people, work like 8 to 5, and then they get out, including bankers. So when we're shopping, they find a home they love, and offers are due the next morning. I can't even get a hold of that banker to get the normal pre-approval letter updated, because we like to have address-specific and budget-specific numbers on our pre-approval letter. It gives us a little bit of a negotiation tactic. You know, we don't want to show them that we have so much more money to play with, but we also don't want to demonstrate that we're not capable of closing the loan. There are many, many times where we are making altercations to pre-approval letters or the loan structure itself in a time period that literally can't happen with a big bank. And I think here's another thing that you don't a part that really surprised me is I went out and I interviewed a bunch, because quite honestly, my reputation is on the line.
That's you.
When I tell somebody else, like, go with this person, and if the deal falls apart, they do blame me, and they should, because I pointed them in a direction that didn't have the best outcome possible, or I led them to someone who wasn't the best fit for them. And I think it's just crucial to think about, A, the availability, quickness, and the actual customer service. Another thing that drives me insane, unfortunately, some clients, they go with their bank because I understand trust. I understand I'm a new face and I have a unique looking face. So there is
best beard in the business.
Best beard in the business. So there is always, you got to trust the people you're working with. I understand when they bring their bank's pre-approval letter with me, but I know that I am handcuffed a little bit to our mobility. And I have heard the way that the customer service is handled with a bank, with someone who's in charge of putting mortgages together, they have a wildly different motivation for their responsiveness than a mortgage broker or myself. It's customer service is the name of the game. We are in the service industry. No, I am, at least, I know you are, but the way we cut it is we help people the most by being very, very much involved with the transaction, with their goals. And a part of that is being available and just having an ear for their ongoing goals, because the goals are evolving constantly. When specifically in low inventory markets, when we're going out and we're shopping, their goals change. Like, I can't tell you how many times that it's just the description is the same. It's, I want a 3-bedroom, bath and a half, 2-stall garage attached with a decent backyard. And the unfortunate answer, and because they'll say, like, I also want to be, let's say, in New Berlin. I'm like, all right, right now there's one available. Before we even restrict the pricing, there's one available, and it's $480,000. Now we're shopping around the $280 to $350 range, and without the evolution of, like, seeing other homes or possibly jumping up or down price point in order to make that dream happen for them, we need flexibility on the fly, because normally when people realize their goals are changing is when they see the new home hit their email or they see the new home online and they're like, that home looks amazing and it's not in my original goal set. And I'm like, we can technically make that happen according to your initial goals. And talking to you, obviously I'll pick up the phone and call you before I give any false promises. And it's important to have that mobility. So the biggest thing in the world, honestly, is aligning myself with someone who I can trust in the process. Because the biggest thing in the world, too, is you are much more involved and gifted and educated in this area. And I love the fact that at any point, I can literally toss the ball to you and I have a great outcome. Or at least I have a very, very, very informed response of why that wouldn't work. Because a lot of people... I mean, the inventory is so small right now that expectations versus, like, inventory reality can really alter a person's motivation behind what they want. I've had people go from, like, I want a single family home here, and then we work all the numbers, and they literally wildly change to, like, a condo in a different area. And even when it comes to single family homes to condos, there's different loan structures. Some condos don't even take normal loan packages or FHA loan packages or whatever. So when I reach out to Aaron, there are certain times where we have to get a condo association back on and get our lenders back on the actual approved site, and that can be a nightmare.
For FHA, correct.
Yeah.
Now for conventional, there are non-warrantable condos based on different factors that can get a little deep, but our CEO Alex has an approval avenue directly through Freddie Mac where he more times than not gets it done. This is very common with new projects going up in the area, new condos. So we can't get traditional financing, so now they're doing a hard money loan or some other type of loan, and that doesn't have to be the case. So we've really been in with a lot of different condo associations and projects going up where we can make that happen, where we need to get a couple different documents. Usually it's bylaws for the condo questionnaire, and the budget, and go straight to Alex. And from there, he works his magic and gets back in touch with us rather quickly. But you said a couple things, Max, where you mentioned customer service and you mentioned the outcome, and the ride's not always smooth. Like we talked about earlier in the example, it might be hey, ultimately we're going to get you to your goal. We're going to get there, but there's going to be X, Y, and Z of hurdles where it's forecasting. It's forecasting the market conditions. It's forecasting the journey in front of us of what's going to be needed. We had somebody that recently had to refinance the car into, they were more than qualified, but due to unforeseen scenarios, they had to refinance the car into the spouse's name, put only one on. Those were extra steps. We forecasted it. We closed recently. They were all smiles at closing. And why I'm saying this, it's not only the outcome, it's not only customer service. We like to think of it as the customer experience.
Yeah.
At the end of it, did you accomplish your goal? Did you get to the finish line? Were things forecasted? Did you have an outlet no matter what time of day or weekend it is? I remember hearing stories about you from clients that we've had the privilege of working together with, where they're like, yeah, sorry, I know we were texting at midnight, and obviously it's not always ideal on a daily basis, but when needed, you're there. We're there.
Yeah.
You know, it's for better or worse.
It's going the extra mile to get a deal done is so important in this market. I mean, I need to stress it like intimately is when there's two homes on the market at any given point, and there's 35 shoppers in that market, and the number of buyers is growing as we get into the season.
Correct.
It is so important to be able to put your best offer forward and to be able to figure out exactly how to make that the most competitive way. And one of the ways is through the way you structure how you're going to do the financing.
Absolutely.
And so here's the best part, because I want to jump in to, you know, we got the pre-approval. I sent all the information necessary for the pre-approval. Now we got the accepted offer by doing exactly what our goals were, or having to manipulate a little bit. After we get the accepted offer and we send all the information to you, what's the next step, and what should like that potential buyer be aware of?
So then at that point, there's a few next steps, but first and foremost, we're going to lock the rate. If the rates then go up, you're locked. We cannot lock the rate until we get the accepted offer. Some people think they're pre-approved.
Yes.
Oh, you pre-approved me last month. I thought rates were this. No, we can't pre-approve until we have the accepted offer on the specific property with an anticipated closing date.
That is a very common misconception, that when they get their pre-approval, they see the rate sometimes on their pre-approval, and they assume that they're doing all the numbers and math, that rate's not changing every single day, every single week. And unfortunately, it changes their purchasing power. Sometimes for great ways, like going into the dip into the low threes.
Yep.
It's fantastic. But sometimes it dips up a little bit and it changes theirs. So it's a common misconception that we kind of have to educate and curb people. It's just like, this is what the rates are at your current situation. Just be aware that there is fluctuation in the market that has nothing to do with you.
Correct.
And that rate's not locked in until when?
Once we have the accepted offer,
Okay.
we're going to immediately call them, do the updating on our side, then call them, and from that point, lock the rate with their permission, let them know, make sure we have the right terms that we talked about earlier in terms of the different options we've probably discussed up to this point of down payment, loan programs, all of that good stuff. And now we lock, but we educate the client at that point, hey, if rates go up, you're safe and secure. However, if they go down, all the way up until 10 days previous to closing, we'll do a one-time rate change at no cost. Basically, we're either breaking the rate with that particular investor because we found another one for you, and we'll also educate the clients with all the different clickbait we talked about a little bit earlier, how to accurately look at rates. Basically, one of the more accurate ones is if somebody goes on Google and literally just types in mortgage rates today, it's going to give you the national average. It's usually as of yesterday is what's on there. And we're usually, as people will see, when they say, what am I at? Oh, you're at 4%. Well, I see on here national averages are 4.3. That's correct. We're lower than that average. So we let them know. We monitor every day. But if you see it, where it jumps down to 4, guess what? We'll probably have it 3.75, and we'll make that one-time change for you. At that point, we're likely to need updated documents unless the pre-approval just happened last week.
Okay.
And so we're going to do the full document collection. We're going to get e-signatures on the loan package and get everything sent off to processing. And if there are any potential hurdles that we foresee, we'll forecast that on the front end of, we're Max in 2 weeks or Allie in 2 weeks, we're going to need a couple different things. Just be forewarned, because now it's important where you're not panicking when we call you up in 2 weeks or send you an email saying we need an update on this or this. You're like, oh yeah, they told me, this is no big deal. We're also, when you first get pre-approved or we get introduced to you, we're going to send you a mortgage guide that's going to go over the full process from pre-approval to accepted offer to all the different steps afterwards. So you have an idea of that timeline in addition to us explaining it to you and forecasting. Then also in that packet is going to be things not to do. Obviously,
don't buy a new car.
Don't buy a new car. This has happened actually recently, and we still are making the loan happen, but my stomach dropped because we really, it's not that I would have done it, but we really care about our clients and their goals. And
so what happens with like your mortgage rate, or does anything change if you buy a car? Like, what I've heard that's really bad. Like, don't make big purchases while you're in this home buying process, but why?
So one of the qualifying factors, and we talked about credit earlier on being one of them, that bucket of the application, a couple of things that we're looking for in that bucket are, one particular, outside of just the credit, is debt to income ratio. So let's say you were approved up to $300,000 with a 40% debt to income ratio. That means all of your monthly debts, not including your phone or cable or anything like that, but all of your credit cards, car payments, the new mortgage, student loans, and if they're frozen, we can take just a 0.5% more times than not on that. So it's usually a very small amount if they're currently frozen. But, you might be at 40% of debt to income ratio, meaning your monthly debts to what your gross income is. Now suddenly a new $600 car payment pushes up to 53%. Now we're over the limit. A lot of times we can get up to 49.99%.
It's
so close.
With that, other times, depending on the program or the credit or other scenarios, it may be limited at 45% or 43%, and this is where we use all those different loan package or loan options at our disposal.
You touched on something really important that, honest to God, actually enlightened me. It's not like a certain dollar amount, because I've had people say like, well, how much can I spend before the loan isn't approved? And it's not necessarily that. It's just the ratio. It's
Correct.
Just if you mess up your financial picture of how much you make a month versus how much you spend, that's what creates an issue. It's not like I spent this much and that number is okay. It's just you're altering the picture of your debt to income ratio, and that is what's going to be the issue, is if you spend enough to make that go over. So I typically, the way I do it is I go, don't spend any money at all unless prior approved by you, because it's going to matter in that debt to income ratio. And since I typically like to remove myself probably from their like savings and stuff, I don't need to know necessarily all of their information. I like to keep that mildly segregated so I don't know everything about their lives, because it's a very personal thing. It's important that when they're making these decisions, especially when I have, because a big thing for me that's been in the past is I just went from an 800 square foot apartment to their first home, which is now like 3,000 square feet. So now they want to furnish it. Well, they start shopping prior to closing and they make me super nervous because they're talking about significant amount of furniture, meaning a significant amount of money, putting it on credit or whatever, or just changing their financial picture.
So then when is it okay to buy something? When can I
It's
decorate my home?
always safe to do it post-closing.
Post-closing?
Yeah.
Okay.
Correct.
Okay, that's when I can start
Yes.
buying everything. Not
Yeah.
from IKEA, from
Yeah.
like a real store
Yes.
to furnish.
I understand it's not the most ideal in every scenario. However, what's less than ideal is you got all the furniture, but now you lost the place.
Oh, where do you put it? Oh,
Yeah.
no.
That's very unfortunate. Yeah.
Okay, so wait, another question that I wanted to kind of back up to. I have not a lot of debt, but like my only debt is my student loans, and that is quite significant. How does that mess up? Like, does that affect my house buying?
It's just factored in to
Okay.
the debt income ratio. So if you're actively paying it monthly, there's the routine payments coming through. It's likely to show up in the credit report that way, and that's what it would get counted as. Currently, right now, a lot of people have their student debt frozen to some degree,
Yeah.
and with that, we're taking 0.5%. So
Of how much I owe?
of how much you owe. So if you're doing the math on that, it's really actually a much
It's
smaller
still so much.
No, that's a
For me.
wildly different value, though.
wildly different. I mean, literally, if you're talking, $1,000, you're talking $5 on that. If you're
Yeah.
talking
Okay.
10,000,
So-
you're talking $50.
Okay.
You keep
That
going
debt
up.
to income ratio, they're taking only 5% of what you owed of what you would be paying monthly.
Okay.
That changes your purchasing power dramatically.
Okay.
Just because you have a lot, honey. It just it just affects it in a positive way now that they're frozen.
Okay.
But it is definitely like if you're making monthly payments or it's whatever unfrozen, they're gonna view it as a regular a debt that you have to pay against your income, and they want to make sure that your percentage is such that you can afford your mortgage.
So in this particular moment, now would be a better time to buy
Yeah.
a house than when my student loan payments kick back in.
Yes.
Based on everyone's personal goals, yes.
It is based on
Yeah.
goals, yes.
But
first and
it
foremost,
is a
but
great
from what you were
advantage.
saying, yes.
Yeah.
If that
so
was
I
a
have
future
a lot
concern.
of student loans and currently not making any payments because we're not paying student loans right now.
It
because of
helps.
COVID. Right now would be the time.
It would definitely help our purchasing power.
Okay.
It wouldn't affect rate though.
It's not necessarily going to affect rate.
It's just about like approval.
Approval. Now, where the debt to income ratio, to your question from earlier, if we're at 49% versus, let's say, 35, that could have a small effect on the rate.
Okay.
That also could have an effect on your PMI that we talked about earlier, because when you're a lower debt to income ratio, you're considered a safer client in that sense of, they've got bigger cushion if they do, were to rack up some additional debt right after closing on furnishing the place, real things. I do want to touch on this for a moment, though. What you mentioned earlier, it doesn't mean going back to the whole furniture thing, it doesn't mean you can't do it. That's where check in with us. We might tell them, hey, you're at 30% debt. You're good. Just
Yeah.
don't rack up 50 grand. But if you're looking for some living room furniture, we were just thinking on a couple grand. No big deal.
Okay.
There's enough there. It very likely could get flagged where we'll have to verify it, but it's stuff that we can work through, and we would forecast that.
So I can basically just use you as my financial advisor from that period of trying to buy a house until closing day happens. Be like, hey, Aaron,
And
what
Yes,
can I
yes.
do with my life right
Yes.
now? Okay.
It's very important to keep that open dialogue
Poor
in.
Aaron. I'm just gonna be calling
Yes,
him
from
all
the
time.
point of shopping to the we were intimately involved. Yes, and it's just really really important that you don't negatively affect your ability to close on the home that let's be honest, in this market took a long time to find, probably took a lot to win, got past inspections, thank goodness, got to the point where now we're getting closer and closer to closing, and then you mess up your loan by going out and buying a car that messes up your income to debt ratio or 50 grand in furniture or whatever. So it's just very important that when you're in that period, you have that open dialogue with both myself as well as you, just to make sure that we don't allow the dream that took you a lot to get to kind of fall apart.
Correct.
Very easily avoidable things. So, I mean, yes, we won the offer. That's fantastic. We don't spend any money. It goes to underwriting. For the buyer, they're pretty much hands off at that point. They're just waiting to hear back from underwriting.
Waiting to hear back.
Yeah.
We're going to send weekly updates to both our business partners in the transaction on all sides, even if it's somebody we haven't worked with before. In addition to the buyer, they're getting unique updates. In addition to being able to reach out, as you mentioned, throughout the process, and that way they know what's going on. And are we through processing? Are we through underwriting? Are we scheduling closing? Are there any conditions that you forecast that we need to work through, or is everything good? So those are all things that come up. Like we have somebody that right now is in the military and suddenly they're on the East Coast and they're we forecast that of, hey, no, it's okay. I'm glad you mentioned it to us now. Those are questions that we asked that led to it. She signed a power of attorney. Somebody else going to sign for her. Closing still happening on time.
That's beautiful.
So there's just different things, like just to give real scenarios of things that might come up. And from there, we're scheduling closing. And then the week of, you're getting the final closing disclosure. And 3 days before that, the estimated of showing your exact amount to close. We're going through it with you, making sure that everything makes sense.
I really appreciate that. As someone who you may know is very detail oriented with the numbers.
You know.
It's really nice to have someone to reach out to and go line by line what those values are.
Absolutely.
Because I know it can be intimidating for a buyer to get like the closing sheet and see like, why am I giving them a credit for like gas, electric, water? And then it's just easily explained as it's prorated, it's every 3 months sort of thing. And to have somebody to go through that with you, because that's when my buyers bring their own people, I am sometimes doing that with them. And I feel awful that they don't have that other resource. Because when you have like 6 different people being like, it's perfectly normal, it's perfectly fine, it's actually a part of the transaction, you're benefiting here, you're paying them a little bit here, but it all evens out at the end of the year, like taxes, when you prorate taxes.
It does. I mean, and with what you're saying as well, on that final closing disclosure, it could be a water and sewer credit of $115, and suddenly you bought the place in November and closed on it, and now you're in January and you're getting this bill showing from October, November, December, and you're going, wait a minute, I was only there for a month.
Yeah.
And why am I paying this? And some people get really frustrated. Now, it was gone through by title, and we went through it as well, which is completely okay. There's a lot of steps and a lot of numbers floating around, and you're excited to get into your new home.
Yep.
So, we tell clients, as I know you do as well, after closing, if things pop up or you have questions on them, reach out. This doesn't end right here, and then we're going through it. Oh, let me look at this. Let's make sure it's accurate. Yeah, you got a $115 credit at closing, so that was $115 less that you came with, but now you have to pay the whole bill for it. Oh, that's what that was. I knew there was something.
Yeah, and to have somebody like comfort you and reassure you that whatever is happening is normal. Because I'm not going to lie to you, they don't do this every day.
Correct.
We literally do this every day. So when we see these things, sometimes it's blasé. Like we don't even that's totally normal. A credit for the water and sewage, I wouldn't even think twice about that. But to have somebody be like, my closing costs are actually like $1,200 more than I thought they were going to be. We can easily explain away line by line, like, yep, and you'll get the credit here and here, and this is a normal bill at the end of the year. It's exactly what we're going through. And I know I do this, and I know you've done it a few times, is we just educate them before they even see that document.
Correct.
Just certain things will be credited in your favor. Yeah, the biggest thing in the world is I want no surprises. Mm-hmm. None. Which is why I love working with A+, and I love working with you, is we don't have any surprises. And if we have scenarios that happen, we've already educated them about what those could be and the pros and cons of each reaction to action. So nobody's coming to the closing table completely blindsided. My heart breaks when I'm on the selling side and the buyer shows up and their agent doesn't show up and their mortgage lender doesn't show up, or he shows up way late and they're just sitting in front of a stack of papers that they were emailed, never really went through, and no one went through it with them. So now they're just like alone in a room, and it's a terrifying experience to sign 300 documents in a row and not really know what each one means.
Yeah.
I love the fact that I make it a practice to go to all my closings, because it's important, especially in that last step, to see a reassuring face in that room who can tell you things like, just have them pay the taxes. Just don't have it sent to your house unless you have like an accountant who gives you an advantage. Like, educate yourself on what that is. But 9 times out of 10, just have the mortgage company pay your taxes. That's a way better deal. And to have also Aaron in the room, it creates a form of trust at the closing table that I really sympathize for people who don't have it. Because the best thing in the world is when you get like a review, like a verbal review from a past client, and they're like, I actually shopped around before, and I like first time I purchased a house, and I didn't know what to compare it to. I didn't have a good realtor. I didn't have a good mortgage lender, and the difference is wild. To have somebody respond to me within like 24 hours, accurately give me the information I needed. I was never surprised in the process. I mean, we had hiccups, but that we're just subject to the market. So everything went smoothly, and I'm so appreciative of you two, and that's awesome, because what that does, kind of, is you make me look amazing, you know? And hopefully I do the same for him, but the feedback that I get from past clients about their experience is so important. It's so important to their happiness in the transaction, how they feel. So even buyer's remorse, where people feel like guilt or something about purchasing a home that was more, it's mostly stemmed from not being adequately educated as to what the expectation should be from the buying process, whether that be through the loan process or shopping for houses. And I am just so grateful that we've been able to pair up with so many great clients and literally create an environment of just safe trust and education all the way through the process. And I'm sincerely grateful, honestly.
Likewise, I appreciate so very much all the kind words. And no, you do make us look really great as well. Allie, you may or may not know this. I'm going to go with you do. But afterwards, or after a transaction that was unique, where suddenly we're gifting, $2,000 or $2,500 to a client in closing costs without the rate really changing very much, and still having amazing options available, Max is saying, we need to chat. And he wants to know why, and not just like that it got done, but he wants to know why it got done, how it got done. And the reason for that is, I know you care so much, and you're going to break it down to other clients. Now you know another tool that's at your disposal to meet those client needs and wants and goals. And that from our side is gold, because we know you're taking such sincere care of your clients, and by the time we talk to them or after, we're working together as a team. It's the same reason why on our side we go to a lot of real estate meetings, read up on that side. We want to stay on top of the market conditions and trends, just like you want to stay on top of the different options and trends on the loan side, where we are truly a team working together for the best interest of our shared clients.
I do love that. It's we both take an interest in each other's profession to the point where, like, now we need a professional. You need to go speak to him. Like, I have very open conversations with my clients. Like, this is where the extent of my knowledge ends, and we need to get Aaron in the conversation, because we're talking about things that I know pretty well, but I'd rather have you have a concrete answer. And I don't ever want to, even if I feel that I know it, I will preface with, we're absolutely going to get, Aaron in this conversation, but I'm pretty sure this is what you should expect. And if I'm not even close to it, I'm just like, let's talk to Aaron. Let's get Aaron in the conversation, because there's a lot of nuances to this. I think most people feel that, like, the home buying process is very, very simple. And then when you zoom out, I don't think they realize that there's real estate agents on both sides, mortgage lenders, closing agents, underwriters. Like, the amount of people who touch your transaction before it's closed is close to 20, 30 people. And of those people, there are probably 2, like Aaron and myself, who are on top of people, on top of schedules, and it really matters. When you help somebody into a home, it's kind of an amazing feeling. And that bond is real. Like, I have grown friendships that started with, they just were looking to purchase a house. And since we spend so much time together, looking for houses, and I have a very unique aesthetic and personality, that it's really awesome to grow into, like, a relationship that's like a friendship, because they get a great experience. And I really value that, because it's unique. I mean, there's 30,000 or so agents in southeastern Milwaukee, and of those, some of them have gotten not the best reviews. And when I talk to those people, I'm like, that is so unfortunate that you had a home buying experience that failed because of A, B, or C. And aligning yourself with a great mortgage lender is a great way to enhance their experience. And honest to God, it even boils down to the person's personality. So Aaron, I don't know if this was on purpose or not, but works with me exclusively. He works with me out of the team exclusively. I started working with Sean, the head of the team, and Aaron now works with me, and Aaron and I click. Mm-hmm. Like, everything makes sense. We have we set expectations of one another, which is, I can't tell you how crazy that is to talk to a different mortgage lender and be like, this is what I expect out of you out of the transaction. And one of them is communication. Like, if I reach out to you, I want to know that you've seen it, heard it, will get back to me within like 24 hours, especially how rapid this market is going.
Correct.
And if you're not available, I accept that completely. Give me the alternative people that I can call in real time when that happens. And having someone just be on top of their individual business and have the care factor is what's so vital when it comes to that. It changes people from whether or not they get the home, whether or not their real estate agent or their mortgage lender got back to them in the time period where the offers are being accepted. Because the unfortunate part is sometimes they see the home after it's been on the market 12 hours, 13 hours, because they went to work, they came home, they ate dinner, then they opened it up and said, oh my God, this is my dream home.
Yep.
That's what accelerates our timeline aggressively, because we want them to win that home. That's their dream home that they've been waiting for. And even with me, if they don't see that, after like 3 hours, I'm pinging them. Like, hey, how's it going? How's the workday going? Can you look at this address and tell me if it's a yay or nay just visually? So it's super important that these relationships are very solid. And I want to sincerely appreciate your time today, especially because I know there's a lot of people who are on the fence of whether or not they want to buy. And I feel like just having people visually see what the conversation is between the real estate agent and the mortgage lender about what the home buying process is puts a lot of people at ease. Because I know that when I talk to close friends, especially not in an office, it's a wildly different experience. These people just have expectations that were given to them possibly by people who either didn't purchase recently or they purchased in a different area, which makes the expectations wildly different. I mean, if you're shopping in New Berlin versus out in like Richland Center, they're different expectations. The amount of buyers out there looking for 40 acres versus somebody looking for a single family home on a quarter acre with high competition. Mm-hmm. It's very much different. And to have you in play and have that mobility of what we're doing is such an important role. So sincerely, like, thank you for coming out today. And then
so to like quick summarize the whole process. The whole process. A to Z. I talked to you because I'm like, hey, I like your beard, so now you're my realtor. Yeah. Now you're my realtor.
It is a phenomenal beard.
Yeah, right. So then
my 5 o'clock shadow was embarrassed.
So I go, hey, this is what my budget is, and you're like, great, let's talk to Aaron.
Yes.
So you point me to Aaron, and I go, hey, these are my goals. We set a down payment and whatnot, and we kind of find the house, finalize, or I get pre-approved.
Yes. So the very first step.
Not my qualification, not my pre-qualification.
You talk to me, we get Aaron involved, you get your pre-approval, we start shopping for homes. Because if we mess up that order, we might not be able to get you the loan pre-approval in the amount of time.
Pre-approval letter comes before home.
Comes before home shopping.
Right. Okay. So then I find the home and I'm like, this one is what I want right now. And then we go back to Aaron and we say, can this work with what we got?
Are we doing our original loan structure or do we have to do something different in order to win the home?
Okay.
Because that's wildly different than being, like, you can be pre-approved and not win a lot of homes.
Sure. Okay, so now I put in the offer, get the offer accepted.
Yeah.
And then I don't buy anything else. I don't buy anything
Cars
else.
Or
nothing.
furniture.
Well, that's where we'll talk.
That's where you
we'll talk.
Because you can
Aaron
do
becomes
that,
my financial
but you just,
advisor. And then we go through the whole thing, like, line by line, so I know why I'm paying for stuff that I'm paying for. X, Y, and Z, know my closing costs. We close.
And then you get updates from me to remove your furnace filter and put in a new one, regardless of how old, and possibly change your locks, because I can't tell you how many people have given out a key like candy to all their relatives.
Sure. So now we closed. I have the house.
Yeah.
I just start paying my mortgage.
You start paying your mortgage. You'll get a letter in the mail talking about your first payment. and then you will set up your automatic payments online, hopefully. Yeah.
Cool.
And at this point, you've closed. You're in the house 15 days. What happens if you have a single question about anything related to your house or your home? Me
I
or
call
him.
You or you.
And that's the difference. Like, you're going to have both of our numbers.
Forever
and you're going to be
and
like, hey,
ever.
I haven't gotten my first... This happens all the time. I haven't gotten my first mortgage payment. Like, I've been in the home a month.
That's terrifying.
Could be a multitude of reasons. Could be like you wrote the wrong address, you did a month.
Oh no,
Or
your old address.
your first monthly payment, right? Doesn't it start...
It's going to be, so let's say you're closing this month here
Yeah.
in February. Let's say you're closing February 20th. It won't be March 1st. It'll be April 1st.
Yes.
So no matter where we are in the month, let's say you closed almost a couple weeks ago, like on February 2nd, let's say, you're still not going to have your first payment until April 1st.
Oh gosh, that's so long. That would send
yeah.
me into a panic.
So
Yes.
it can, where suddenly 2 weeks goes by, you haven't gotten your payment information yet, you call us. We're going to look into it for you. We're going to give you a number to call. I've had that happen before where I've told people it's probably on the way. At this point, we can't actually talk on your behalf because we're not actually on the loan.
Okay.
Yeah.
But we're going to troubleshoot. We're going to get the answers for you. I just had this, like, literally, I think it was a week or two ago, where they were texting me back that afternoon saying, yep, all set up. And then the very next day, oh, they took a picture, sent it to me. It came the next day. And it was still 3 weeks before the payment was really due.
Okay.
But they just, sounds like you might be similar where you said it might drive you
Yeah.
nuts, where you're detail oriented and
Yeah.
care and want to know. And that's great. And that's why we're available for you.
Sweet.
That's awesome.
Glad you guys are there to answer my calls.
Well, shoot, thank you, Aaron, sincerely, for coming out and doing this. This is a really big deal.
Allie, Max, thank you both. Thank you for your time. It was an honor and a privilege to join you and share some market and mortgage insights. And again, thank you both very much as well. It was great.